Good morning, everyone. Today we have Chris Melvin with Corebridge to talk to us about fixed indexed annuities. Chris?
Awesome. Well, thank you. Good morning, everyone. As I said, my name is Chris Melvin. I'm actually going to be the regional director for the Northeast region. I'm going to be a part of a team of three, and we all specialize within annuities. So I'll be handing out my contact information to Juniper. And if you guys have any questions regarding annuities or what we offer, just feel free to reach out to her or your dedicated marketer, and they will be able to assist you guys. But just to tell you folks a little bit about myself, I was born and raised in California. Grew up fairly nerdy. So I was in Boy Scouts, played board games, read comic books, you name it, anything nerdy, I was doing it. But one thing that really stuck with me as a kid and now going into my adult years has been the toy Lego. And I find it pretty therapeutic when I build my Lego sets at home and use that time really to unwind from like a week of travel or perhaps even something that's just keeping me occupied, right? I still get the same joy as I do or as I did as a kid when I step into a toy aisle, whether that be at Target, Walmart, used to be Toys R Us, but now they don't have that anymore. But in a lot of ways, I like to associate this feeling of joy and content with what you're going to be or what your clients may be expressing as they begin to unwind themselves and reach into their retirement years. And it's at this point that they've accumulated all their assets or Lego sets for the sake of the analogy, and are now starting to put the pieces back together and really start to develop their retirement plans and goals as well. One of my fondest memories as a kid was having my dad there, to help me build those sets, which in reality, he was the one building them because I didn't have that mental capacity at the time. But it was nice having an extra pair of eyes who I felt like they knew what they were doing. And that's your role as the agents for these clients, right? You're the one who have those watchful eyes over their retirement plans, really helping them build or bring those pieces together within retirement. So as you start to help build and bring those pieces up, there's going to be some questions that start to fly out. How are we going to solve for income within retirement? How are we going to hedge against inflation? How are we going to protect our assets if there's some market downturn? So I'm going to share my screen with you guys here, and I'm going to share with you guys a piece called our flip book. Let me get this pulled up. And what the flip book is it's actually going to be a compilation of what, can you guys see my screen yet or no? Can you guys see my screen now? Perfect. Okay. So what this is going to be is a compilation of many pieces that are going to be from our fund partners or people who are going to be leading within the industry. We feel like this can help really tell the story or really drive the story home with your clients, as it's going to be coming from leading voices within the industry and not the person who's trying to sell to you, right? So this piece specifically is going to be from BlackRock. It's going to be one that I really like, and what it's going to be going over is three different types of investors. It's going to be that same idea where, as an investor, you put your money in early, you allow it to grow, you don't touch it. So as like you're putting it into a 401k, an IRA, whatever it is, and they've all grown to a certain point. So here we have the assumption with those three different types of investors of a 7% average return overall over the course of 25 years. And then they're going to start to begin to take their withdrawals at 65. Well, what happens when we start to take the withdrawals at 65 is we see now those lines start to separate and defer, right? Things are going to start to change for them. Now you have things that may come across as a market correction, or you have inflation, or in recent times, right, we're dealing with rising costs. These are going to be worries that your clients may have. And these worries actually are going to be something that we conducted our own survey on, and we found that 59% of Americans fear running out of income prior to death. So what are the things that we could do to help mitigate this? And that's where we're going to come in with our index annuities in particular, and we're going to be offering the clients protection, growth, and income. So let's go ahead and pull up another thing here. Bear with me. Got this stuck. Now, the pieces that I like to go over here is going to be something that we also have called the triangle piece. And what this is going to really lay out the strategies that our index annuities can provide for your clients. And this is just going to be on a general basis, both for in New York and outside of New York. So index annuity is going to be very similar to the fixed annuities that you guys are probably already selling, as fixed annuities rates have been at an all-time high within the past few years here. It's the same course for our index annuities. So let's start off with protection here. Protection or your index annuity is going to be outside of the stock market, which means that there's going to be the index annuity itself will not be participating in any market volatility whatsoever. And on top of that, with the general no fees that the client, or there's generally going to be no fees with the client when it comes to an index annuity, because it's still technically considered a fixed annuity. So no fee drag, no participation in any market volatility, and it's going to be the power of zero. So if nothing, or if the client is in a negative market, or if the market or the indice that they're tracing doesn't perform, that just means that the client's going to get nothing for that year. And then vice versa, if there is any positive returns, then the client at the most is going to get whatever their cap rate is going to be at. Which brings us to our growth potential. Now, the average return of bonds has been around 4 to 5%, relatively speaking. Because rates are so high right now, our cap rated strategies and trigger rated strategies are going to be at all-time highs as well, where we could potentially outperform what clients have been getting on an average return from a bond. So taking a look at here, this is going to be based off one of our 7-year index annuities outside of New York called the Power Protector. We're going to see here that our cap rated strategy is at an 11% cap. And that's going to be without the income. Or what we have is, and what's starting to become the more industry standard, is going to be the performance trigger rate, which will be at 8.6%. What this means is, for a cap rated strategy, think of having a glass and the rim of the glass is at 11%, right? So if the S&P index performs at a 6 or 7%, that client captures that interest rate and is applied to their account value. Now, if it overflows, right, and goes above that 11%, then the client won't receive anything above 11%, but we can guarantee that they'll have an 11% cap for that year. Trigger rate, now that it's becoming the industry standard, is becoming something a little bit more interesting. So if the S&P performs and just gets a 1% rate or 1% return, the client gets an 8.6 rate for that year. If the S&P returns at a flat 0, the client is still getting 8.6%. If it performs negatively, then the client receives nothing. But again, it's a power of 0. The client hasn't lost any of their premium. And unlike being in a bond or any money market, right, the client will have lost either their interest or lost value to their assets that they have put in. In New York, rates do differ. They are going to be, we currently are offering the highest rates within New York. They are going to be a little bit down, but New York has its own constituents that go into play, or factors that you have to put in, as New York can be a little bit more difficult, or is notorious for being a little bit more difficult to work with. That being said, cap rates within New York will be at 9.25%, and then our trigger rate will be at 7.35%. So still beating out that 5, 6%, 4% average that you may have gotten from a bond in years past. Now, the next thing is going to be our income. So there's 2 things that we do for income. In New York, it's going to be more towards a fixed annuity with an income rider, which is going to be called the Assured Edge. And we'll touch on that at the end, and we'll go over a tool that helps with that. But outside of New York, things are different. So we have 2 income levels that we work with. We either have level income or we have max income. The idea of max income is offering your clients more in terms of withdrawal early on in retirement, and then towards their later years, or what we call the slow-go years, when things start to dial back a bit, they're not traveling as much, they're spending more time at home with their family, the withdrawals will come back down. And that's, once a client spends the account down to 0, it will drop down to the stated rate here, or the protected income payment is what we call it. So let's say here, everything is going to be age banded. So between the ages of 65, 69, the average years for clients who are looking to retire. For max income, for a single life, we're looking at a 9% withdrawal guaranteed until the account gets spent down to 0. Then it's going to be 6 guaranteed for life. Joint, it'll be slightly less, 40 basis points less. But the benefit of the joint is if one client predeceases the other, then the surviving spouse will be able to continue the benefit for the rest of their lives as well. Now, for level income, something that your clients or maybe you're more used to within the industry, we're going to see that it's going to be just a level 7.5% rate guaranteed for life at the age of 65. Same thing, 40 basis points lower in joint life as recovering 2 lives as well. The great thing about this, the rider is only going to be a 1.1% fee. In the past, what you're probably going to see, or what you're probably going to see and hear now from clients, are that annuities are expensive. And that may have been true when it comes to a variable annuity where you're seeing an average of 3 to 4% in terms of a fee drag. Well, with this here, you're going to be looking at only a 1.1% fee at max. And then without an income rider, of course, there's going to be no fee associated whatsoever. Now in New York, the higher withdrawal rates are going to be with the Assured Edge. Let me get a placemat pulled up here. Now, this website here also has access to all of our fixed annuities, all of our index annuities and products that we offer, as well as marketing material. And this is fully accessible to you folks as well. It doesn't require any password or anything. And it also has our calculator that we can run in it. So taking a look at the placemat here first. Make sure this one is for New York. Here we go. This is going to show you exactly how the withdrawals and everything are calculated. So product in New York, it's completely free. There is a 3% compounding rate that is within the product. On top of that, the withdrawals are going to be determined based off when the client signs is a withdrawal rate that they lock in. You could run this as single and joint. That means that even if a client is going into an annuity with an IRA, we could still have joint income on this, as we're doing joint life on the rider and not the structure of the annuity itself. So at the age of 65, we'll take a look here. We see that the client locks in a withdrawal of 7%. Blow this up a little bit. You see that the client takes a withdrawal of 7%. And then for every year that they choose to defer that income, the withdrawal rate actually increases by 1/4 basis point. Very simple, very easy. On top of that, that 3% compounding rate, once the client activates income, all the interest that has been gained will be applied to that withdrawal as well. The last tool that we have with this is going to be the income calculator, which I did have here. That's all right. We'll pull it up here. Here we go. This, again, is also going to be accessible. Your client could actually use this at home as well. This is going to be the assurededgecalculator.com. And all the links that I'm sharing with you guys today, I'll also pass those on to Juniper. She can forward them out, again, to your marketers or anybody that you're contacting, and they could also provide these for you. But as long as you have a phone, you have a tablet, some internet source, you'll be able to access any of this. So this can help calculate your income and really help push the story forward when you have your clients in the office. We could run this as self or self with spouse. Just keep in mind, if we do run it with joint, it's going to be based off the younger of the 2 clients at all times with any of our income products. We'll run this at the age of 65. We'll just select New York for the sake of it, as we were talking about it. And then we'll put the spouse's age at 65. There's 2 things that we could do. We could either solve for the required premium, or we could solve for the income. So you could back up into it or just solve for the income as well. We'll just run the income for now. We're going to defer for 5 years, put in the premium amount of 100,000, run the calculation, and now we're guaranteed $8,984 for life. The next thing after that is if you want to have your clients go home with something, all you'd have to do is hit next. It will download a file for you. We get it pulled up here, and it's going to be more of a traditional illustration telling you exactly how we got to that income, and the client can take it home with them. The cool thing is, like I said, the client could do this at home themselves and share this with their friends and family. So they're able to push that story out there and potentially bring in more clients for you folks as well. So just to recap what uh, we've gone over our index annuity or protection, growth, and income. So we have protection where your clients are going to be outside of the market. They're not going to participate in any market volatility. They have the power of zero. And on top of that, there's no fee drag. We also have growth, which means that we have our cap rated strategies, currently the highest within New York, and very competitive outside of New York. And then we also have our withdrawal rates, which are currently going to be the highest in the industry across the board, both in and outside of New York, especially within a 1 to 5 year ratio. And that's what I have for you folks today. Any questions, thoughts?
I have a question.
Yes.
The Assured Edge New York, how is the death benefit calculated? Let's say the client only collected 5 years worth of income. How is the death benefit calculated?
So it is just the contract value. So it's dollar for dollar reducing whatever the client's taken out, whatever the contract value is at that point, just gets paid out as the death benefit.
Okay, thank you.
My pleasure. Any more questions? Anybody want to see some of my Lego collection? No, I'm just kidding.
Yes, I have a question.
Yes, sir.
In most of the annuities that I've worked with in the past, leaving out the income rider, is there a withdrawal permitted and are there surrender charges?
Yes. So the
New
index,
York, I'm talking about.
okay, yeah, perfect. So within New York, there is a allowable free out, which is going to be 10% after the first year, and then it's a 7-year surrender. I believe it's 876 reducing, but let me check just to be sure. Materials. Oh, here we go. So it's 987,654 reducing. And then there is that 10% allowable free out after the first year.
Okay, so now the trigger you said was 8.5?
Correct. So the trigger here, the trigger rate. Sorry, this little tool keeps dropping down here. I'm going to try to get to it. Here we are. It is going to be currently at 7.35% outside or in New York. Outside of New York, I believe it's 8.25 or 8.5.
Okay, now that's a lower trigger than some of your competitors outside New York.
Outside
New
New York,
York,
yes. Outside New York, we're having just competitive rates, but in New York, we have the highest rates currently.
okay, so is there any reason that I could not just use the trigger as my funding and withdraw 7.35% and not pay the fee for the income rider? Any reason I couldn't do that?
No, you could do that as well.
And I could withdraw 10%, but eventually I would go to zero principal because
Correct.
I'm withdrawing greater amounts than the earnings.
Exactly. So the reason for the income rider would be to guarantee the lifetime income. So even if you were to spend the account down to zero, now the money's coming out of our pockets and the client's guaranteed income for life at that point. And then if they have a joint life on it or a joint spouse, they'll be able to cover that spouse even if it goes down to zero as well. So the client spouse could be covered within retirement, making sure that they're supplementing their income with their Social Security or maybe even covering RMDs for future.
Thank you. I've been told that there is going to be a change next year in the New York regulations that will permit you to become more like the non-New York products. You have
I
anything to
didn't.
say about that?
I was not aware of it, but it's something that I have to look into.
Okay, thank you.
My pleasure. Great question so far. Any more?
Well, thank you so much.
My pleasure. My pleasure. And like I said, I'll be handing out all the links and everything that we have available. I'll send it over to Juniper. She can forward it out to you folks. If you guys have any questions, feel free to reach out to them, and then they'll get in contact with us as well.
Chris, I do have one more question.
Yes, sir.
If my client resides and works in New York,
Mhm.
and my office is in Florida, and we've been doing business together for 10 years, and they come down to Florida can I offer them the non-New York product and we sign it in New York, in Florida?
Yes. So the way that the products work is it's going to be based off where the client signs is the product that they're going to be using. So if they come down to Florida and they're using it there and they're signing there, that's the contract that they're going to have to, basically they're using outside of New York.
Oh, that's interesting. Thank you.
My pleasure. Perfect.
Excellent. Well, thank you so much. I will get everything together once I have it, and I'll send that out for everyone.
Thank you. Thank you, Juniper.
Welcome. Everybody have a great day.
Thank you,
Thank
everyone.
you.
Thank you. Bye.